This is video 6 of IAS 20. We are going to continue with the presentation of government grants. As we've already said, you need to distinguish between the two types of grants. We've already done asset-based grants, and now we will continue with income-based grants. And here is our definition for income-based grants. It is government grants other than asset-based grants. Therefore, if it is not an asset-based grant, it will be an income-based grant. And normally, this relates to specific expenses. For example, if you need to train your staff, that training expense is for what the grant will compensate for. And those specific expenses is what we're going to use to determine our paragraph 12 systematic basis. So what are our two methods under the income-based grant for presentation? You can either have a separate credit in profit and loss. In other words, you have a separate income in profit and loss. Or you can decide to offset the grant against the expense in profit and loss. In other words, you just reduce the expense with the grant. Okay, so how are these two different? So under the first one, you receive the grant, you debit bank and you credit deferred revenue. Very important, remember, this is an SFP item. Then, when you amortize your deferred revenue, SFP, to profit and loss, you decrease the deferred revenue and you credit government grant amortized in profit and loss. So now you have a separate income in profit and loss. If you chose the second method, which is to offset it against the expense in profit and loss, you still debit your bank and you still credit your deferred revenue SFP. Then when you amortize it to profit and loss, you still debit your deferred revenue and you credit the expense in profit and loss. So now you decreased the expense with the grant. Let us look at an example. The government indicated that it will subsidize the gross salaries of employees between the ages of 18 and 25 years by 40% for a period of 12 months after employment. So when we employ these employees, the government will subsidize us with 40% of their salaries for the first 12 months. The subsidy becomes effective on the day on which the employee is appointed, but is only paid to the employer at the end of the first month after the date of appointment. So, what was the reason for this grant? The reason for this grant was to compensate for salaries. So this is more for a specific expense. It is not for an asset. Therefore, it is an income-based grant. Then further, Batman Limited appointed 10 employees in this age group on 1 January 2007. The employee's initial gross salary was 75,000 and the employees receive a 10% increase in gross salaries every 6 months. Okay, so their annual salary is 75,000 Rand each. So we first have to work out what's their salary for the first 6 months and then add an increase to that for the next 6 months. Then on 1 July 2007, a further 4 employees were appointed which qualify for the subsidy. These employees' conditions of employment are the same as those employed from 1 January, so they also get the increase. Except now their initial gross salary, annual gross salary, is 90,000 Rand per employee for these 4 employees. And then Batman Limited has a 31 December reporting date. So let's go and look at how are we going to calculate the salaries for these employees. So for the first 10 employees, okay, so they have a gross salary of 75,000, which we work out for the first 6 months. And then after that, we add an increase to their salaries. So we have their total gross salary per employee per year, and we know the government subsidizes 40%. We times that by 10 to get our total subsidy for the first 10 employees. Then let's think about this. The whole expense for which this grant is intended for. The expense was there for the whole year. So for the first 12 months, they were all employed. The subsidy is only available for the first 12 months. Therefore, the whole expenses in this year, therefore the whole subsidy can be recognized within this year. So the full 315,000 can be recognized. Let's go and look at the next 4, which is a bit different than the first 10 we did. Okay, so they have a gross salary of 90,000, which we take to 6 months. We increase that by the 10%. Times that by 40% to get the subsidy, and times 4 to get the total subsidy. So this is the total subsidy. But how much of the expense for this subsidy was recognized in this year? Only 45,000 of the full expense of 94,500. So how much do we recognize within this year? Here you see that the 45,000 over the 94,500 times the full subsidy of 151,200 gives us what is recognized within this year. Okay, so only 72,000 of this subsidy will be recognized in this year. Then also the full 350,000 that we've already discussed. So let's go and look at our journal entries. So we receive the grant day 1, we debit our bank, credit our deferred income for both grants. Then we've already incurred our staff costs, which we just recognize in profit and loss. But now the question is, how much of the deferred income, SFP, can be amortized to profit and loss? This is our question now. So we've already calculated this in terms of the previous slide. Okay, so now on our methods of presentation. We debit our deferred income, then we can either decide to create a separate credit in profit and loss, which is a separate income in profit and loss, or we debit our deferred income and credit the expense and thereby decreasing the expense. So here are 2 methods that you guys need to know for tests.